for the quiz, but we won't have to do any calculations for the quiz. But I want to show you how to do them just because it's useful, just to show what goes behind it. So in the very short term, price level is fixed. Aggregate demand determines aggregate quantity sold. So prices are fixed in the very short term. So aggregate planned expenditure equals planned consumption plus planned investment plus planned government expenditures plus planned exports minus planned imports equals real GDP. So anything like if consumption goes up, real GDP will go up. If planned investment goes up, real GDP will go up. If government spending goes up, real GDP will go up. If exports go up, real GDP will go up. While if imports go up, real GDP will go down. So if we're buying more from other countries, real GDP will go down. Even though we need things from other countries, like for example, bananas we can't produce here, it's while we need those things, it hurts our GDP. Anything we buy from other countries, it hurts our GDP because it's a cash outflow. So we're spending money, we're not taking money in, while exports are cash inflow. So everyone wants more exports than imports because that means that we're making more money than spending. So consumption and saving depend primarily on disposable income. So real GDP minus taxes plus transfer payments. So we want to have more real GDP than taxes and transfer payments. So we want to be saving. So as you can see, we want to be in the blue region on this graph at the top here. We want to be saving. That's the best thing for us. We want to be generating more income than we're spending. That's very key. That means that we can save and then we can invest. So that's important. If we're dissaving, we're going into debt. So dissaving, we're going into debt, and that causes a lot of problems to us because we may have to sell off assets to pay off that debt, or we may go bankrupt, which would hurt our credit rating, and we won't be able to borrow for a long time. So saving function shows the relationship between disposable income and savings. So we want to have an increase in income. We want to have more income coming in than what we're spending. So our growth in income should be greater than our growth in spending. And marginal propensity to consume, MPC, is the fraction of income that is consumed. So it's change in consumption divided by change in income. So we want to have a low marginal propensity to consume. So it's basically the percentage of income that we're spending on consumption goods. While marginal propensity to save is the fraction of income that is saved. So it's the amount of income that we save. So ideally, we want our marginal propensity to save to be higher than the marginal propensity to consume. That means that we're saving more percentage of our income in terms of having to invest with. So if we add the marginal propensity to consume, marginal propensity to save, we get 1. So we're either spending money on consumption or saving. It's either one of the two. So we want to be saving more than we're consuming. That's ideal for us, just so we can invest more. So increase in expected future disposable income. So shifts saving function downward and consumption function upward. So consumption and saving are a function of real GDP, since increase in real GDP increases income. Import function relates imports and real GDP. So marginal propensity to import is a fraction of income spent on imports. So that's the fraction of income spent on imports. So the marginal propensity to consume is equal to the change in consumption expenditure divided by the change in disposable income. Other things remaining the same. It is measured by the slope of the consumption function. So in this case, in part A, the marginal propensity to consume is 0.75. So that means that we're consuming 75% of our income while we're saving 25% of our income. So that's not a good ratio. That means that we're spending 3 times as much as we're saving. So that's not ideal. We want to increase our marginal propensity to save. So I'd recommend in this situation to find ways we can cut expenses. So look at where you're consuming and seeing if it's a need or a want, and figure out what you can cut so your marginal propensity to save can increase. So just evaluating everything that you're spending on and figuring out what things are needs and what things you have to have. So thinking through every purchase would be a good way to find how to save more money. So components of aggregate expenditure interact to determine income, and aggregate expenditures influenced by income. So aggregate planned expenditures is two parts. So autonomous expenditure, investment, government spending, and exports. That's the part of aggregate expenditure that does not vary with income. So with for the most part, investment, government spending, and export, they don't vary that much with income, while consumption minus, so everything we spend above our savings / investment is a part of aggregate expenditure that does vary with income. So that's called induced expenditure. So that's everything that's whatever we consume, then that's higher than investment. That does vary with income. So the multiplier is the amount by which change in autonomous expenditure is multiplied to change, determine change in equilibrium expenditure in real GDP. So multiplier, how the multiplier works is it shows the amount of return you get on spending. So it shows if a multiplier is, for example, 1.3, that means that the return on every dollar invested in that thing, you get 1.3 times on that money. So that would be a 30% return. So it shows how much money you make off of an investment. So for example, if the multiplier for infrastructure is 1.5, for every dollar you invest in infrastructure, you'd make $1.50 of return. So that's how a multiplier works. It determines how much return you'll get on every dollar spent. So the it's a good way to see which is a good investment. So in this case, if you invest $50 billion in this case, in the multiplier is 4, you multiply the 50 billion by 4 and you get an increase of 200 billion. So with a multiplier of 4, that means that every dollar invested will return $4. So it's a good way to determine the right investments. You could develop a multiplier for many different investments out there and then figure out which investments have the higher multiplier. So in my opinion, based on analysis, I would say the investments with the highest multiplier would be companies that have high return on equity, high growth cash flow, a great competitive advantage, industry with lack of competition, trusted management that is not corrupt. So those types of things, like things that Warren Buffett and Charlie Munger look for, those investments would have higher multipliers than other investments. So looking for investments based on Warren Buffett and Charlie Munger strategies, the strategies of Berkshire Hathaway, you can determine the investments with the highest multipliers. So you can develop a multiplier for each investment based on all those factors. So the higher the multiplier, the better. The higher the multiplier, the higher the return you have on every dollar invested. So a multiplier of 4 on the left here, that means that every dollar invested, you get $4 back. Multiplier of 2, every dollar invested, you get $2 back. Yeah. So aggregate demand curve shows the relationship between real GDP demand and the price level. Other things remaining the same and can be derived from the aggregate expenditure curve. So these shifts here, these shifts here, for this graph on the bottom here, the aggregate demand graph here, you want the So for this graph, you want it to shift right. So ideally you want it to shift right. That's key for it to grow. So this would be an increase in aggregate demand. So if it shifts right, it's an increase in aggregate demand. And then for aggregate expenditure, if it shifts up like this, that's an increase in aggregate expenditure. So as you can see, the fiscal policy here will be focused on Keynesian, while the monetary will be focused on the money supply primarily. So topics for today: money, monetary policy, taxes, and fiscal policy. So we'll cover all of these things here. So macroeconomic intervention. So macroeconomics, we were talking about the economy as a whole. Just as we discussed in microeconomics, the government must sometimes intervene to help stabilize the economy. What are some different ways that the government can impact demand in the entire economy? So I'll ask you this question in the chat here. Yeah, so fiscal policies, we can do that. Yes. So increasing government spending, reduction in taxes, we can do that to impact the economy. Tariffs, correct. Yeah, tariffs would could be used as a fiscal policy tool. Yes. So increasing tariffs can shrink the economy. So that's an increase in taxes. So that would shrink the economy. Yes. So yeah, good examples there. Yeah, so those are types of things that the government can do to impact the economy. So money. What is money? So history of money, bartering, trading goods for goods, requires a double coincidence of wants, which means each person needs to want what the other person has. So bartering was what we had before money. We traded products. So it was very difficult to do that because how can you trade a car for a house? Food for service, it becomes difficult. While commodity money was something that we use, currency with its own intrinsic value. So we use cows, silver, shells, grain. Gold was used. Then coinage, precious metals. Then paper, first in China, becomes acceptable as we get more and more used to the idea that money is a thing that helps transactions, doesn't need to be useful in itself. So what happened with that was gold was used as money for a very long time. And then what happened was people started putting gold into the bank as a deposit just to keep their gold there. And the bank would give us back receipts in the form of paper just to say that we had all this gold in the bank. And what happened was the bank didn't have enough gold on hand for all of us. So the receipts didn't show, like the receipts maybe had, let's say 100 pieces of gold on it, while there might have been 50 in the bank. And if people asked for their gold back, there wasn't enough gold to get back for the receipt. So that became a problem. And then eventually Richard Nixon would cancel the convertibility of the US dollar to gold because there just wasn't enough gold in the vaults. And the US didn't want to give up all the gold that was left because there wasn't enough gold to pay people back. So what happened was the paper receipts that people got for the gold, they just used that as currency now. So that was how cash was created. Cash was initially a receipt for the gold you put into the bank. Now cash is just cash. It's not converted. It's not tied to gold. We can just print as much as we want, which the US is doing, Canada is doing, and other countries are doing, without tying it to anything. So that's what happened. And so functions of money, medium of exchange, we exchange money for goods and services. It is widely accepted. Measure of value, we can compare this value of various goods using money. Store value, money can be saved and used at a later time. Characteristics of money, for money to be accepted, should be portable, durable, divisible, recognizable, accepted, protected from counterfeit. So here, let's do this as a class. Decide if each of the following items fulfill the functions and characteristics of money. Put a check mark if they do and an X if they don't. So for cows, which characteristics would cows meet here? So yeah, it could have a store value, Nicole. Yes, it definitely has a value to it. Yeah. What other characteristics? So Anthony says medium exchange, yes. Value, recognizable, widely accepted, yes. It would definitely meet those. Um, yeah, I would say that it couldn't be portable because it couldn't fit in your wallet. It's not very durable. Like it's not like it would was yeah, it's not divisible, it's not portable, it's not durable. Yeah, so there's a lot of issues that cows would have. What about silver coins? So yeah, durable and portable. Yeah, everything. So yeah, Nicole. Abigail durable and portable. Anthony everything but divisible. Nicole durable, measure value, portable, recognizable. Yeah, it has a lot of the benefits here. So I would say that it meets everything except I would say divisibility is a big problem. Like Anthony noted, it's hard to divide silver. Yeah, so that would become a problem because silver has a market value. If you go to Yahoo Finance, you can figure out the value of silver. And yeah, it'd be hard to divide that for sure. So what about flowers? So yeah, I would say so yeah, so Nicole says maybe only value versus portable. Yeah, so it would become a problem because of the decay, the compostability. I think that would become a problem. The We wouldn't be able to have it forever. So if it was worth, let's say, $1 million, a bouquet of flowers, once once they started to decay and decompose, then that's gone. So that becomes a problem. And it's not very durable because it wouldn't withstand a lot of like if someone had it in their pocket, it would just kind of have issues. So there's a lot of issues with that. What about plastic water bottles? So you have portable and durable, yes. So what about any other things? Portable, divisible, measure of value, okay. I think the issue with the plastic, yeah, as you can break down plastics, yes. I think the issue with plastic water bottle would be very difficult to make it so it doesn't become counterfeit, because it's very hard to um make it authentic. So I think that would become a problem with plastic water bottles. And then you can't really put it in your pocket. It's very hard to divide. Um, it's not very portable in terms of money, so that those would become problems with it as well. What about diamonds? Oh yeah, so Anthony says all. I would say you could use it for exchanging products, yes. Measure value, yes. Store value. It is portable, durable, divisible. I think the problem would be divisible. I think that would be one problem with it. I think that for it to be divisible, we'd have to cut it, and that would become an issue. Recognizable is correct. Widely accepted would be correct because it could be widely accepted, because it's very hard to fake it. Like it's a diamond, right? Like you can there's tests you can figure out it's diamond. You can make sure it's not counterfeit. It's not a cubic zirconia. I think the one problem would be divisibility, but it has a lot of these factors. So I would say that it would be a good candidate. So I think out of all these, I would think silver, coins, and diamonds would be a good candidate. So very well done, class. So this is what goes through to determine what should be a currency. So coins to paper money, this transition is key to explaining the development of banks. People began to take their coins, which are heavy and easy to steal, and put them in banks. Banks then gave people receipts, and thus paper money was born. So the receipts were showed that you owned this much gold slash silver. The next step, banks had lots of gold in their vaults. People didn't actually pick up all of their gold at any one time. So what does a bank to do? Lend. So loan money. Banks let people borrow money to make profit on the interest. Requires people to not take out all the money they deposit. So if you deposit money into your bank, the bank's lending that money out to earn interest. So that's how the bank does it. However, the bank can't just invest all that money into anything. It's mostly just mortgages. They can only really invest their money in mortgages because that's the lowest risk asset they can own, because if someone doesn't pay their mortgage back, the bank seizes the house. So there's securitized loans. The loan is secured by the value of the property. So the bank will own the house if the person doesn't pay back the loan. So the government restricts banks to do this just so it'll reduce the risk. So people will be able to, so the deposits won't be lost in investments that are really risky. So, but it's a very lucrative business for the banks because they make billions in interest per year on this business. So interest rate, the cost of borrowing, or the reward for saving. If I want to borrow $100 at 10% interest, then I will have to pay back $110. If I want to save $100 at 10% interest, after a year, I will have $110. So yeah, so interest rate is the cost of borrowing or the reward for saving. So you want to be on the reward for saving side as much as possible. So you want to be earning interest as a reward for saving, as opposed to as a cost for borrowing. So that's very important. So borrow as less as you can. You probably will have to borrow for a mortgage one day. Like if you buy a house or condo, you probably have to borrow for a mortgage, which is, I think that's good debt there. But try to minimize your borrowing as much as possible, and try to save as much as you possibly can. You may have to borrow for a house and a car, which I would say are good debt. That's good debt because that's debt for things that you need. but don't borrow for other things. There's certain things, like I said, car and house / condo, that you should borrow for, because that's useful stuff. Those are useful things. But don't try to borrow for anything else, because that becomes a problem. Try to save as much as you possibly can. So banks want people to deposit their money and save it. Why? When people deposit their money, the bank can take their money and loan that out to other people. But people can't borrow money for free. If they want to borrow money, they have to pay interest until they pay back the loan. This is extra money that the borrower has to pay the bank, so the bank earns interest every time people borrow money. Bank runs, however, sometimes people would panic and all try to get their money out at the same time. This leads to a bank run. Bank run is when large investors pull their money out of the bank at the same time because they're afraid the bank will become insolvent. So the central bank is born. Central bank is a national bank that provides banking services for the government and for commercial banks. Commercial banks provide services to citizens such as saving, borrowing, mortgages, etc. Central bank is a banker to commercial banks, loans banks money in case of bank runs. They do not provide services to citizens, issue a currency, manage foreign reserves. Central bank controls monetary policy on behalf of the government. So the central bank provides loans to banks like TD, RBC, Scotiabank, Banks of Canada, just in case they need money to pay depositors. So if the bank has lent out all the money in their bank to mortgage holders, then they may have to ask the Bank of Canada for some more money to pay for withdrawals. Because if anyone wants to withdraw money, the Bank of Canada may have to step in to give that money because the bank doesn't have it currently due to loans, mortgages. So how do commercial banks affect the money supply? Even though these banks don't have the right to print money, these banks can create money, but how? The key to this lies in the fact that people do not want all their money at one time. Otherwise, why put it in the bank at all? So what does a bank do with all the money they leave in the vaults? Credit creation. So this is the fractional reserve banking cycle, credit creation. So this is how money is, this is how the banking system works here. This is a really good example. So credit creation, when people save money at the bank loans out some of their money to other people. John deposits $1,000 in the bank. The reserve requirement for the bank is 10%. This means that the bank must keep 10% $100. They take the other 90%, $900, and loan it out to other people. Step 2, the bank loans the $900 to the local business owner who buys $900 of materials for Lucy. Step 3, Lucy takes $900 she earned from selling materials and puts into the bank. Step 4, the bank keeps 10% of Lucy's deposit, $90, and loans the other 90%, $810 to a driver that puts new tires on his car. Step 5, the tire salesman just earned $810 from selling car tires to the driver. He deposits into the bank. The bank keeps 10% of his deposit, $81, and loans the other 90%, $729. So the system of credit creation continues until there's no money to be loaned out by the bank. So this is what happens. The bank puts, let's say, 10% in as a reserve, just in case depositors need their money back, and then they loan the other 90% out. And then this keeps going, and this is how the bank makes money and creates money. So fractional reserve banking cycle, we can calculate the total deposits and total credit creation using the credit multiplier. The credit multiplier equals the reciprocal of the reserve requirement. Reserve requirement equals 10%. So credit multiplier, we do 1 divided by 10, and we get, 1 divided by 0.10, then we get 10. So reserve requirement 10% is the same as 0.10. We do 1 divided by 0.10, we get 10 as the credit multiplier. Total deposits, initial deposits times credit multiplier, $1,000 times 10 equals $10,000. This means in total $10,000 will be deposited. Total credit creation, initial credit creation times credit multiplier, 90% times of $1,000 times 10 equals $9,000. This means that $9,000 of credit was created from the initial $1,000 deposit. So limitations, the money multiplier equation assumes that all excess reserves get translated into new loans. However, amount of people such as businesses looking for loans might be small as people save. The type of people looking for loans might not be the type of people that the bank wants to loan to. So you still have to check their credit requirements. So if they don't have the income needed for loans, if they don't have the credit rating, they don't have yeah, if they don't have the income or credit rating, then they may not be able to get a loan, even though they want a loan. Monetary policy. Monetary policy, when the central bank impacts the money supply and interest rates. Monetary policy, the purpose of monetary policy is to impact aggregate demand. Central bank changes interest rates and the money supply to either encourage spending and increase aggregate demand, or discourage spending and decrease aggregate demand. So, yes, so let's skip this here, but interest rate is the cost of borrowing or the reward for saving. The interest rate determines how much people will borrow and save. The interest rate is high, it's expensive to borrow because you have to pay back more money. If the interest rate is high, it's a good way to save because you're saving more money. If the interest rate is low, it's cheap to borrow because you don't have to pay back so much money. If the interest rate is low, it's a bad time to save because you're not earning much interest. So how can the central bank use this information to increase or decrease aggregate demand? So based on this, I'll rephrase the question here. So how can the central bank use this information to increase or decrease aggregate demand / economic growth? Then he says they can borrow at low interest rates and give out loans at high interest rates to decrease economic growth. So they can borrow at low interest rates. So borrowing at low interest rates, the benefit of that is they can invest, let's say, in infrastructure, and they get a higher return after paying the debt off. So let's say the rate of return for investing in infrastructure is 20%, and they can borrow at 1%. They're after they pay off their debt payments, their return will be 19%. So a lower interest rate is better for economic growth because a lot of economic growth is paid for through borrowing. So and then also giving out loans to high interest rates, that's what the banks do. So yeah, so the banks could borrow at a low interest rate. Yeah, so the bank can borrow at a low interest rate and then lend at a high interest rate and take the margin. So that's their whole business. So the bank, if the bank can borrow at 1% and lend out at 5%, they take that difference of 4%, and then that's their profit. So that's their whole business, is lending at a higher rate than they're borrowing at. So, for example, when we deposit money, we're earning a very low interest rate. It's much lower than 1%, but they're using that money to lend at a 4, 5, 6, 7% rate. So they can take that difference, and they're benefiting off of our deposits because they're making that a lot of money off of lending our deposits. So that's why it's so important to invest your money that's in the bank, because the bank is really benefiting from your money you put in the bank. So if you can invest it and make a very high return, you don't have to think of what might have been if you just had it in cash. So make sure to invest. It's key to invest what you have in the bank. In exchange traded funds, for example, like I said, like an iShares or Vanguard, S&P 500 exchange traded fund, that's a good investment because you can get a high return on your savings. So easy / expansionary monetary policy is used during times of recession to help boost the economy. You can decrease interest rates that encourages people to borrow and spend, thereby increasing aggregate demand, increase the money supply, make more money available to people, therefore increasing aggregate demand. So either reducing interest rates or increasing the money supply, both are very beneficial for the economic growth. So that's what the bank does a lot when the economy is in recession, so they can grow the economy. So they can either decrease the interest rate or increase the money supply or both to grow the economy. So they do this in the trough section of the business cycle. So in the trough or recession / contraction, they can increase the money supply and decrease the interest rate to help the economy. So the trough is when things are really bad in the economy. Recession / contraction is when things is reducing a lot. So that's when there's a lot of negative growth in the economy. While peak is when everything is at its best. That's when the employment's at its best, when economic growth is at its best. Recovery / expansion is when everything is growing. It's not quite at its peak yet, but it's growing. Yeah, so the economy goes through these cycles constantly. So it goes through the cycle all throughout history. There have been these cycles repeating. So, so expansionary monetary policy can stimulate the prosperity cycle here. So how easy monetary policy works: buying government bonds and other securities. Government bonds are a way governments borrow money from banks and investors. They sell bonds, investment opportunity to investors and banks, and receive money in return. Investors and banks loan governments money because they expect to receive the principal, initially invested amount, back with interest, just like any other loan. When a government buys a bond back, they're turning the bond back into cash, i.e. putting cash back in the hands of citizens. This increases the money supply and therefore increases aggregate demand. Cash ends up back in the banking system, multiplies the money multiplier and fractional reserve banking system. So to increase the money supply, the Bank of Canada buys government bonds. So they do that because that injects money into the economy. So they're buying government bonds from companies, from individuals, and that money more difficult to obtain, therefore decreasing aggregate demand. So this happened pretty recently in Canada. So the inflation was very high pretty recently, and the government increased interest rates and decreased the money supply to bring down inflation. So that's the policy that they take to bring down inflation. This may hurt the economy, so this may lead to less economic growth. But the reason why they do it is because if prices are growing too high, that's a huge problem. People need to be able to afford groceries, housing, and all these other things. So these are things that the government does that can reduce reduce the price level and make it more affordable. So they can increase interest rates and decrease the money supply. So those are the things that they can do, and they did that. But affordability is still a problem, and it's likely due to a supply shortage. So this is what you can do from a monetary policy standpoint to bring down prices. You can increase interest rates and decrease the money supply. But then the issue in Canada with specifically groceries and housing is that it's a supply shortage. We just don't have enough supply of these things, and we need to produce more in order to make it more available. The prices are high because we just don't have enough supply of it. So that's something that can't be fixed that can't at all be fixed by monetary policy. We need to be focusing on fiscal policy for that in order, and also economic growth in order to fix those problems. So contractionary monetary policy is used at peak to help slow down the economy and decrease inflation. So usually at the peak economy, employment is at the highest level, economic growth is at its highest level, but the flip side of that is that prices are too high. That's the drawback of this. When the economy is doing very well like that, the drawback of it is prices are very high. So we need to bring down prices. So if we increase interest rates and lower the money supply, we're going to lower aggregate demand. So that's the flip side of bringing prices more affordable, that our economy will shrink. So that's the flip side. So there's always a trade-off. So how tight money policy works: open market operations, selling government bonds. When a government sells a government bond, they use money out of the money supply and replace it with an asset, i.e. the bond that is not counted in the money supply. This means that citizens who spend money in the economy now have a bond instead of cash. So the money supply has decreased and aggregate demand will decrease. So money is taken out of the economy through selling government bonds, and that leads to less money supply. So to reduce the money supply, the Bank of Canada sells government bonds to people and corporations. They can also raise interest rates. This is a clear way for the bank to communicate to the public what policy they're pursuing. This makes it harder for banks to borrow from the Federal Reserve, therefore more difficult to make more loans. Reserve requirements: central bank can increase reserve requirement. This means banks can't loan out as much money. This shrinks the money multiplier. So increased reserve requirement means that the bank has to keep more in cash and not lend it out. So that leads to a lower money supply, because if they're keeping it more in cash, they can't lend it out and they can't create more money. Can the central bank change the foreign exchange rates to impact aggregate demand? So I'll put this in the chat for you here. So can the central bank change foreign exchange rates to impact aggregate demand? So when I say that, I mean currency values. So can the central bank change the currency value to impact aggregate demand? Yes, exactly. They can. So how? What can they do to affect aggregate demand? Yes, so if they lower the interest rate, they can reduce their currency value. And reducing their currency value makes their exports cheaper to other countries, and then their exports can increase because they are cheaper. So that's a strategy they can use to increase their exports. So that's a good strategy that a lot of countries have used. So foreign currency exchange rates, expansionary monetary policy. If the central bank wants to increase aggregate demand, they can change the foreign currency exchange rate. How? By impacting exports. Remember that exports are one of the components of the aggregate demand formula. For expansionary monetary policy, the central bank wants to increase exports. They can do this by decreasing the value of their own currency against another currency. Instead of $1 Canadian equals 5 RMB, which is the Chinese currency, they change it to 1 Canadian dollar equals 4 RMB. This means that companies in China buying goods from Canada now can buy more with their money for a good that costs $1 Canadian. Before they had to pay 5 RMB, but now they can pay 4 RMB. This will increase exports and therefore increase aggregate demand. So this is a strategy they can use to grow their economy. This is what a lot of countries have done to grow their economy, is reduce the value of their currency. So it's a great strategy if their country needs more economic growth. Contractionary monetary policy. If the central bank wants to if the central bank wants to decrease aggregate demand, they can change the foreign currency exchange rate. How? By impacting exports. Remember that exports are one of the components of the aggregate demand formula. For contracting monetary policy, the central bank wants to decrease exports. They can do that by increasing the value of their own currency against another currency. Instead of 1 Canadian dollar equals 4 RMB, they change it to 1 Canadian dollar equals 5 RMB. This means companies in China buying goods from Canada can now buy less with their money for a good that cost 1 Canadian dollar. Before they had to pay 4 RMB, now they have to pay 5 RMB. So it's more expensive for China to buy Canadian goods. This will decrease exports and therefore decrease aggregate demand. However, in this case, Canada can buy more things from other countries because their currency is worth more. So if the Canadian currency becomes worth more, the Canadians can buy more products from other countries. So that's the benefit. They can have more imports when their currency is worth more. So when your currency is worth more, you can buy more imports. So you could buy goods from other countries, and that can be beneficial as well. Taxes. Taxes money paid to the government through the purchase of goods and services and through income. We're all paying taxes every time we purchase goods and services. The government spends tax money on social services, welfare, infrastructure, healthcare, education, etc. Types of taxation: income tax, tax on the income, wages, salaries, etc. Corporate income tax, the percentage of the company's annual profits. Sales tax, payable on the purchase of goods, consumption goods and services. Excise tax, a specific type of sales tax, usually fixed amount of goods we don't like socially, e.g. cigarettes. Capital gains tax, tax on the gains from assets such as stocks through appreciation, closely associated with income tax. Property tax, tax on the value of buildings and land. How do we design a tax system? Benefits received usually associated with consumption taxes versus ability to pay income taxes, efficiency, raising the most amount of money, but still not causing disincentives, versus equity, fairness, again, not trying to create perfect income equality. So categories of taxation: progressive taxation. Households with higher incomes pay a larger share of their income in tax than households with lower incomes. So this is our system in Canada. Proportional tax, all households pay the same share of their income tax. Regressive tax, households with higher incomes pay a smaller share of their incomes in tax than households with lower incomes. So we're progressive here, progressive in Canada, where households with higher incomes pay a larger share of their income in tax than households with lower incomes. That's the Canadian system. So progressive tax system, with progressive taxation system, the first amount of your income is taxed a lower amount than the rest. So the first $0 to $10,000 is taxed at 15%. Your next $10,001 to $50,000 is taxed at 20%. Your next $50,001 to $100,000 is taxed at 40%. These are called tax brackets. So example, a family with a taxable income of $27,400 taxed as follows: 10,000 times 15% equals $1,500. 17,400 times 20% equals $3,480. Total taxes paid, 4,980. So 1,500 plus 3,480. So that's how it works in Canada. It doesn't sound like any country would want to have type of regressive taxation. So that would become difficult for people with lower incomes if they're paying a higher percentage of their income in taxes than people with higher incomes. That would become difficult because people, they might not have enough money to pay their taxes. After paying off for all their needs, they may not have enough money to pay taxes. So that would become a problem. Tax rates can't equal taxes paid. So although all these types of taxes are required to be paid, some people don't pay them. This could be legal or illegal. So they could do this through offshore banking and clever accounting, tax deductions, children retirement, special savings accounts, donations, and tuition. So those are things. So like a lot of the time there's offshore tax havens that that people can take advantage of where they pay less tax or no tax at all. That does happen. So like places like the Panama Papers, that came out a while back. The Paradise Papers, it showed individuals that were hiding their money in tax havens. That does happen. Yeah, Switzerland, and they said yes, Switzerland is a place that this has happened as well. So yeah, so just to avoid taxes, they've used these options, but for so these are other ways. Tax deductions are perfectly legal. There are things that we can deduct from taxes. So like something like tuition, donations, special savings accounts, retirement, and like children expenses, we can either deduct or get tax credits for. That's why I recommend getting a good accountant to find all these tax credits and deductions that you can claim, because there's a lot of things that you can claim, especially tuition, just to bring down your tax liability. So I recommend getting a good accountant to do that, because it's a good way to save on your taxes. And this is all legal. So tax deductions and credits, those are all provided by the government. So make sure that you save these receipts so you can claim them in your taxes. Types of budgets: the government brings in money through taxation. Citizens pay various types of taxes, and the government uses this money to provide goods and services to the country, as well as pay off their debt. It is rare that the government has a balanced budget. So deficit is when government spending is greater than taxes. Balance is when government spending equals taxes. Surplus is when government spending is less than taxes. To balance a deficit budget, you either raise taxes or cut spending. Debt and deficit do not mean the same thing. So deficit is spending is greater than taxes. Debt is money owed to someone. So basically, government debt is when you add up every deficit every year. So deficit is a yearly thing. So deficit is when spending is greater than taxes for a certain year. And then to get all the debt in the country, you have to add up all the deficits. And that's all the money that's owed. So in Canada, it's over $1 trillion currently for the government. And that's that's every deficit added together. So deficit, cyclical deficit, the government needs to increase their spending on social services because there has been a decrease in consumption. Therefore, spending is greater than the amount brought in through taxes. Structural deficit is a deficit during periods of economic prosperity. Automatic stabilizers, mechanisms built into the economy that are continuously stabilizing the economy. In a recession, you don't have to wait for politicians to agree. They're already doing the job. So unemployment insurance, like I said, that's a automatic stabilizer. So once a recession happens, people become unemployed and they get money through the unemployment insurance program to support them through the recession. That's automatic. The government doesn't have to do anything. It's already implemented. It just kicks in right when there's a recession. Progressive taxation also, when people make less money, they pay less tax. So that's something that can help them. In a recession, they pay less tax. So that's a savings for them in a recession. So the progressive taxation automatically kicks in. When people make less income, they pay less tax, so they're saving money on something during the recession. Other welfare programs kick in as well. So other welfare programs, ODSP, other ones can kick in. Fiscal policy. So fiscal policy is when the government impacts government spending and taxes. Fiscal policy is government's way of influencing the business cycle of an economy by manipulating government spending and taxation. Governments want to avoid huge peaks and troughs. So expansionary fiscal policy is when government spending goes up, taxes go down. Contractionary fiscal policy is when government spending goes down, taxes go up. Expansionary fiscal policy is used in times of recession to encourage consumer spending, lower taxes to increase disposable income, increase government spending to help people suffering in difficult times. So expansionary fiscal policy is used at a trough to help boost the economy into recovery/expansion. Contractionary fiscal policy is used in times of inflation to discourage consumer spending, raise taxes to decrease disposable income, and decrease government spending. So contractionary fiscal policy can reduce inflation, which is a good thing. Also, contractionary fiscal policy can be used to raise taxes. So the government may need more money, so they may want to raise more taxes. That's contractionary fiscal policy. Also, if they want to decrease government spending, that's contractionary fiscal policy. So the government wants to save money, that's contractionary fiscal policy. So contractionary fiscal policy is used as a peak to help slow down the economy and decrease inflation. So the fiscal policy is controlled by government. Tools used are government spending and taxes. Monetary policy is controlled by the central bank. Primary tool used are money supply and interest rates. Fiscal monetary policy limitations, both demand side only, cannot impact supply. Expansionary policies can cause inflation. Contractionary policies cause unemployment. Fiscal policies, problems with government corruption. That does happen. So there could be issues with the government pockets money from the government. That becomes a problem. Slower process, very hard to kick in. Monetary policy effectiveness in recent years, uncertain. It's very hard to gauge, not targeted. So recap: fiscal versus monetary policy. Expansionary is used during times of recession to boost the economy. Monetary policy increase the money supply, decrease interest rates. Fiscal policy decrease taxes, increase government spending. Contractionary used during times of high inflation to slow down the economy. Monetary policy, decrease money supply, increase interest rates. Fiscal policy, increase taxes, decrease government spending. And then so let's do this practice here. So 4 actions that can be used at a peak to help slow down the economy and inflation are what here? So you reduce government spending, that's correct. That's one of the things we can do. What else can we do to bring down inflation or slash slow down the economy? Tighten credit and lending policies, excellent. So yeah, raise interest rates, lower the money supply, excellent. Increase taxes, yeah, that's another thing. So like tariffs can be used to reduce inflation. That could be an option, or reduce economic growth. Increase interest rates, yeah, well done. Good job, Anthony, here. That's great. And then what about 4 actions that could be used in a trough to help boost the economy into recovery and expansion? Yeah, Abigail, you reduce taxes. Yes, that's a great strategy. That's definitely one of them. Yeah. So this says basically the opposite of everything mentioned previously: decrease interest rates, loosen credit and lending policies, increase government spending. Yes. So yeah, I think good job stating that. Opposite of everything. Yeah, you just do the opposite basically. Yeah, so well done there. So we covered all this here, and these are some videos that are here I recommend watching. It's in the 6 PDF macroeconomics demand side policy.